Hi, everyone. This is Jason Barrick of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is CEO of the McAlvany Group of Financial Companies, McAlvany Wealth Management. He also hosts the McAlvany Weekly Commentary. It's a podcast. It's a great one. It's been going on for many, many years, over a decade, once a week, about a 40 or 50-minute episode. David McAlvany, thank you for joining me again.
Jason, good to be back with you again.
So, David, we're recording this interview on Friday, May 5th, 2023. The Fed earlier this week hiked again. They're just causing more and more pain. We've had, 12 months now of kind of record-setting pace of rate hikes. Do you think that the lag effect finally, with all these interest rate increases, is finally catching up to a lot of these entities that have lots of debt?
Yeah, not only did we have the Fed raise rates this week, but the ECB did as well. The fight for inflation is still on. So as far as their stated mandate is concerned, the biases continue to raise rates. And, we've long said they'll raise them until something breaks. That is what's happening, is we've got things breaking. Now, to what degree is that behind us versus still ahead? And so to your point, the lag effects have sort of a real economic bite landing June to August. And so, if you wanted to argue for sort of the official launch of recession, that's when it would be there. We've already seen the increase in rates change the dynamic for bank credit and a tightening of bank credit, a tightening of lending standards. That's already in play. And what was really convenient for 2022 was a massive amount, trillion, over a trillion, almost $1.5 trillion in bank liquidity increase in 2022. That's not liquidity that's going to be available in the marketplace 2023. And particularly when we get to the back half, we're dealing with the lag effects of the increase in rates and then the knock-on effects of tightening bank credit as well, which will put a little bit of a squeeze on economic activity.
Well, I think it's even worse than that for these regional banks, and we'll see if it spills over into the larger banks, although JP Morgan was able to buy all the good assets, and I'm using air quotes here, from First Republic Bank. It looks like the Federal Reserve Bank and the FDIC subsidized or sponsored JP Morgan to go and buy the good assets of that bank. But it looks like the regional banks, and we were discussing this before we started recording, I'm listening to these podcasts on Wealthion and elsewhere, and they're bringing on these Fed apologists, supposed banking experts. And the banking experts, David, are talking about these banks are not going to go bankrupt, the regional banks, and they're just going to hold their losing bond portfolios to maturity. Well, that kind of works out only in theory if the regional banks don't need to go to the market right now and try to raise equity capital to fix their balance sheet. But it looks like a lot of these regional banks definitely need to go raise equity capital to go fix their balance sheets.
Yeah, this is the reality. You have an increase in rates, and the first round of pressure was felt on long-term assets, your mortgage-backed securities and treasuries, which is, as you pointed out, have to be mark to market in the event that depositors want their money back. And so that's a question that I have, sort of as we move to the second round of this. When does the money stop flowing out of regional banks? When does it stop being motivated by a 5.25% return? If I can go to treasurydirect.com and sit in short-term treasury paper, arguably far superior in terms of a risk profile to a bank cash deposit, and if I'm sitting at the bank, they're going to pay me 1, 2. If I go to JP Morgan, I can lock it up in a 5-year CD for 3.5%. This is the point, Jason, is you still have money coming out of the banks, forcing the reveal, right? This is the classic Warren Buffett, you get to see who's been swimming naked when the tide rolls out. I'm not saying that every bank has the same issues. So whether it was SVB or Signature or FRC, PacWest, who knows who's next? And the differences will be there. And that, I think, is what's going to be talked about is, oh, well, these guys had commercial real estate. Oh, these guys had jumbo mortgages. Oh, these guys had a security portfolio which was underwater. And it'll look like there's one-offs that can be solved by the FDIC. But the reality is money is flowing out of the banks for good reason. if I can earn 5% versus 3 or 2 or 1, why wouldn't I? Why wouldn't I? So the money continues to flow each as that deposit tide rolls out. Each of these banks has a different form of naked. Maybe it's completely buck naked. Maybe it's a bikini. Maybe it's a monokini. I mean, whatever it is, the banks are all in a different form of stress because deposits are leaving,
So you're
and you're
saying it's
continuing to see that.
so
You're continuing to see that in terms of the inflows at the Treasury and at TreasuryTrack.com.
So you're saying it's a combination of greed and fear, not just one or the other. So if you're an investor and you're saying, well, this regional bank has potentially risk and they're not offering me a good interest rate, I can get a guaranteed higher interest rate either directly from the Treasury or take more risk and go to a money market fund, or I can go to a larger bank. So those are the options or gold. So investors are looking at that versus keeping cash in a regional bank.
Yeah, if you go to a larger bank, it's because you think they're too big to fail, and the federal government or the FDIC is going to back your play, which frankly is a little bit silly because we already had Janet Yellen step out and sort of offer an implicit guarantee of all deposits, whether it's insured or not insured. And she's backpedaled on that. But the reality is, if this banking crisis continues to get worse, there will be peace and calm brought by blanket guarantees. So does it matter if you're at a regional bank or a big bank? I don't think it matters at this point. I don't think it matters at all. I don't think you're going to lose money as a depositor. I think where you're losing money is where you're not getting compensated, and where you are at a deeply negative real return because they're paying you 2 and inflation's 5 or whatever the case may be, right? That continues to be the case. So I think you're right. There's some combination of greed and fear. What this ultimately translates into is a reasonable concern about the stability of the US dollar. If it is that you can buy financial market security, what exactly is the cost? What is the cost? And I think the cost is, stability in the US dollar. We're sitting here at 101 if you're looking at a chart, and it's been bouncing in this 101 to 103 range. And you break below 101, and we're going back to the era of trading into the 90s, 80s, maybe even 70s relative to the euro index. This is a period of time where there's likely to be more pressure on the US dollar as the powers that be try to buy financial market security.
Now, you brought up how the depositors at the regional banks are probably going to be taken care of by the FDIC. That's provided they're under the limit. So if you're a really rich person, maybe they'll get some extra type of rules. Unfortunately, we're in a new normal now where it seems like the rules are changed, or there's different sets of rules all the time, or the goalposts are moved constantly. But I think if you're a shareholder of a regional bank, you're a bondholder of a regional bank or a shareholder of one of these regional bank stocks, you're probably going to get wiped. It looks like they're going to save depositors, though.
That's exactly right. And that's what I'm saying is it doesn't matter if it's 250 or 5 million. If you're a depositor, they want stability within the financial markets, which is a very different objective than saving the bank investor, either the bond or stock investor in banks. And I've had multiple conversations with very, very astute investors, and they're just celebrating the fact that the worst is behind us and it's time to start looking at regional banks. And I've expressed some concern because, again, the cause is not what everyone's pointing to on an idiosyncratic basis. While SVB was tied to Silicon Valley, high risk stuff, all the private equity and venture capital. And again, you can look at these and say, well, that must have been the cause. No, the cause is the Fed keeps on raising rates. So the short end of the curve is way high, and you go out 3, 5, 10 years, and it's a lot lower. And it creates a weird incentive structure where it does make sense to look what you can get on your money in the short term. And if you're looking very far out on the horizon, you're a guaranteed loser. You're a guaranteed loser. Sitting in 10-year treasuries or sitting in JP Morgan's 5-year CD, you may be safe, quote unquote, but you're still underwater relative to inflation. Why are you doing this to yourself? So the money will continue to flow out. The destabilization of the deposit base and the forced mark-to-market nature, whether it is a securities portfolio, a loan portfolio, mortgage portfolio, commercial real estate portfolio, all of these things are going to be under the limelight and under pressure. And so I don't think the worst is behind us. If you are a bank investor, this is going to be still, tough road ahead, very tough road ahead.
I agree. And I'm speaking with bankers off the record, and they're telling me the commercial real estate problems are really just starting. So we're only in the first inning. What I see, David, and it really hasn't even started yet, except for a handful of smaller regional banks. We haven't seen the real mark-to-market losses yet for the bond portfolios of people holding older of entities. So either pension funds, insurance companies, different size banks that have been holding older bonds, either corporate debt or government debt. If you held those bonds for years while the Fed was raising rates, you have big losses, because the higher the rates go, the new investor wants the new bond at the higher interest rate. So these entities, whether it's a pension fund, insurance company, banks, they're sitting on many trillions. I've seen one bank analyst, Christopher Whalen, he's saying the banking industry in the United States is sitting on at least 5 trillion of losses if they're marking them down mark to market. So they need to fix their balance sheets and raise equity capital. But we have the Fed apologists that are going on these podcasts and on financial TV saying that the banks are just going to hold to maturity. Well, can the insurance companies, the pension funds, and the banks just hold everything to maturity? Is the Fed going to change the accounting rules like in March of 2009, like they did for the large too big to fail banks?
Nothing's off the table. And the rules do change in the middle of play. That's the way this gets played. I saw some chatter yesterday about angst over shorting bank stocks, and there's no doubt that that's going to be restricted at some point, perhaps very soon. And then that happened during the 2008-2009 global financial crisis. It was no longer possible to short bank stocks. You could only go long. One thing that relates to commercial real estate and the implications for your regional banks, we're already marking to market losses of, say, 22% in the commercial real estate space, and we are not yet in recession. This has never happened before, Jason. This is what's really unique, is we've already seen pressure in commercial real estate. We're not in recession yet. What does the decline in commercial real estate look like when you're in full-blown recession? I think this is why Blackstone put out their $30 billion distressed real estate package. They want to be able to buy assets at a 40 or 50 or 60 or 70% discount. And I think somewhere between 40 and 50% is probably the realistic destination. But that's a lot of loss. That's a lot of pain. And, that's not accounted for at these prices.
Oh, yeah, I agree. I think we're seeing a textbook example of the Austrian theory of the business cycle play out. I called it the teardown boom. So I was speaking with local real estate developers for years now here in the DC metro area, and they were just bragging how easy it was to go raise capital, borrow money, and they would go and buy an old house that was built decades ago on an expensive piece of land, either downtown in a bad neighborhood in DC and gentrify it, or in a nice neighborhood in DC metro, an old house, knock it down, turn it into a McMansion, or they do the same thing with commercial real estate and tear down because of artificially cheap interest rates, a strip mall that was 1 or 2 floors, and then turn it into a giant office park, or a 1 or 2 floor, a mixed use building that had 1 or 2 floors of expensive commercial real estate on the first couple of floors, and then luxury condos 7, 8, 10 floors up that were super expensive. And this has been going on, David, for 15 years.
Yeah, I mean, and that is the nature of easy credit, right? Misallocated capital. It looks like you can't lose, and you do win so frequently that you just get used to it, and you think that's the way it goes. And then the terms of credit change. When the terms of credit change, all of a sudden everyone's thinking a little bit differently. And I think we're at the front edge of that. The interesting thing about interest rate history, and you might say, does anyone care? It's quite fascinating. These trends last for decades, not quarters. So to think that the worst is behind us, when interest rates begin to move in a different direction, they don't do so for a month, 2 months, 6 months, 3 quarters, a year and a half. In 200 years of interest rate history in the United States, we've had an average of about 36 years. The shortest directional trend in interest rate history was 22 years. And all this was sussed out by Louise Yamada years ago when she was a part of the technical analysis team at Smith Barney. and Alan Shaw. The two of them do an amazing job, or did an amazing job when they were on the same team. 22 years is the shortest, 36 is the longest. We just put in 40, coming down, breaking the old record in terms of duration of interest rate trend. And now we've got a pretty strong indication that interest rates are on the rise. A part of that is because inflation has been stickier and is likely to continue to be sticky as you look at some of the things that have supported sort of a price deflationary environment. Global trade has been robust, free trade internationally, our ability to buy cheap goods from all over the world. All of these things have sort of allowed us to exist. It's just a different world. And I think we're in a new period of time where inflation is sticky and stays higher for longer, and interest rates continue to move higher for longer. And I'm not just talking about what happens between here and the end of 2023. Again, we're talking about something that has a 7 to 10 year stretch on it. And if history is anything of a guide, we're actually talking about multi-decade trend to higher rates.
And also, I think even if the Fed were to cut interest rates enormously, David, now I think the damage is already done. I think the market's dealing with a new normal of interest payments on the debt. These companies are looking at their balance sheet that, we borrowed way too much debt at cheaper rates. Now we have much higher interest payments on our debt. It's hurting us financially. And then also, I think the commercial real estate bust, I think this is probably going to be the worst commercial real estate bust in many, many decades, but it's really just started. So there's people out there that are saying, I've been warning about commercial real estate for a year, 2 years, and nothing has happened. Well, these things, from speaking to bankers, these things are slow, very slow moving, opaque valuations. You're just starting to see now a few commercial real estate developers here, their default on 90 million in bonds, 150 million in bonds. I think some of these other funds, it wasn't, I think it was Blackstone and Starwood. They shut down their commercial real estate funds because they don't want investors pulling the capital out now. And then you said the other one's looking at distress raising capital. So all these things are happening. This is very slow moving with commercial real estate. So this is kind of like the last real estate bubble, the residential one, in 2004 or 5. And that bubble lasted quite a few years longer than people expected.
Yeah, monetary policy for some time has been predicated on this idea that inflation was not going to be a problem. And now that it is, a lot of the assumptions about how they've operated for the last several decades have to be looked at again. And so the interplay between monetary policy and fiscal policy also needs a recheck, because the numbers might have worked if you could maintain zero interest rates, right? You can continue to run up the national debt to 30 or 40 or 50 trillion, as long as you have very little to pay in terms of cash flow outgoing. Interest on the national debt, but it becomes a very significant number as a percentage of total tax revenue. We're already at 31 trillion and having to adjust higher as sort of the current IOUs roll off and we bring on new ones and they're reset at a higher number. Well, by 2032, the Congressional Budget Office has us passing $50 trillion in national debt. And what if interest rates continue to, quote unquote, normalize, which would be at higher numbers? Again, we're talking about being in a position where we have to make some tough choices. Are we going to continue to pay Social Security and Medicare? Well, yes, because there'd be a revolt of the gray hairs if we didn't. But there's consequences and choices and trade-offs, and fiscal and monetary policy are not geared towards dealing with these things. They've gotten used to the free lunch. What do you do when you deal with hard costs and real trade-offs?
So you're talking about Social Security still being paid. You're talking nominally. So people would get, say, a check for a couple $100s a month or something, but the purchasing power of that currency in the check, it might be devalued by 20, 30, 40% over a very short amount of time if the government spending continues and the currency debasement continues.
Look, we could be looking at an incredibly changed world where Social Security, the average recipient's getting $20,000 a month, but it's because we've
in Zimbabwe dollars,
the new U.S. dollar, which may be a digital version, may be a central bank digital currency, and we have this idea that the dollar is stable, that fiat is stable, and it has been stable for some time. But you go back to earlier periods of stress and strain, even periods of deflation, and people wanted to move to cash as a way of de-risking their exposures, whether it's financial market exposures or bank exposures or whatnot. But cash in earlier eras was measured in ounces, not in stacks of greenbacks. And I think that's one of the things that you're seeing now, Jason, is this move towards gold, regardless of inflation numbers coming down a bit. And by the way, when we've seen inflation come down in the past, I mean, this was the case when Volcker came in. It looked like he was out of the gates victorious, and inflation was coming down, and then boom, it's back on the run into double digits, and he's got to take radical actions. But if you look at the interplay of policy, rate shifts, interest rates, inflation, it looked like you had an early victory. It looked like you had an early victory when Volcker was in, and then boom, it exploded in his face to higher numbers. And so to see rates come down here, inflation rates come down here, really not a surprise, really not a big deal. What I think is really intriguing is that investors are seeing through this, and central banks are seeing through this. They're seeing destabilization, and you can define both destabilization and insecurity in about 5 different ways, and it's translating into a different sort of action. Doesn't matter if you argue for inflation or deflation, that's no longer relevant in the equation for most investors. It is a changed global order, and it is a changed view of global security. And that's both at the level of geopolitics, economics, and even public policy. And so when you see the angst expressed, smart money goes to gold. It's private, it's portable, it's got a lot of factors that fiat doesn't have. And so, I think that's going to be a really interesting story that plays out over a decade, not over the next 6 months. Gold breaks out above 2000, and that's going to be an interesting story for 2023, right? So this year's gold story and hype is around getting to new highs and a breakout, and where does it go? No, the real gold story is how central banks continue to add to their holdings and maintain sort of a stable demand component as investors wake up to a destabilized world, financial markets, economy, geopolitics, and all the things that we've taken for granted since the end of the Cold War in terms of peace, stability, increase in free trade. As you increase economic frictions, you increase political and geopolitical frictions as well. And the smart investor says, gosh, a lot of risk here. Where's the reward? Where's the tailwinds to growth in equities? How can I buy government bonds at a negative yield in real terms? This is the dynamic in play, Jason, that I think continues to feed a gold bull market that has not 6 to 12 months, but maybe 5 to 10 years still ahead of it.
I think the new gold bull market just restarted in the last 6 to 8 months. I mean, gold was in a trading range. It hadn't done much since September 2020. It had underperformed the consumer price index. I was just hearing people say, like, I'm selling my gold, I'm buying Bitcoin, I'm going to cash, I'm going to treasuries. There was just all this negativity about it. And then we started to see, as you pointed out, the data coming out from the central banks. And it's not the G7 central banks, it's the non-G7 central banks. So the countries that really are not quote unquote allies with the US. I think they saw what happened with Russia, Russian reserves, all the sanctions. And they said, if we buy all these US treasuries, even though they're quote unquote risk-free, when they can get 4%, over 4% returns, quote unquote risk-free, they said, well, look at what the US government did with the sanctions on Russia and their reserves. So we need to diversify away from US treasuries. And I think that's probably one of the major reasons why China, Germany, and Japan are not large net buyers of US treasuries anymore.
Yeah, I mean, I think you've got a lot of central banks asking that age-old question, can I have the return of my money? And do I really even have to be concerned about the return on my money? If the Russians can lose 300 billion overnight, and they're not going to get it back, that changes the dynamic of reserve asset managers. You've got $7 trillion in reserves that have to be directed towards some currency, towards some position, towards some financial market position. And if it's in the US dollar nexus, that is a question. Return of? Because it's supposed to be the standard bearer of a risk-free asset. It's the benchmark as a risk-free asset. unless you lose favor with the administration. And if you lose favor with the administration, then you're back to the return of your money. And the Russians are hosed on that front. That is the floor set under the gold market. Central banks have been net buyers since 2009, and it's increasing gradually. Now, all of a sudden, we get to see what it looks like to see investors compete with central banks for a finite supply. And this is where most people don't appreciate how inelastic the metals markets are, how completely inelastic. You can't run extra shifts just to create more product. It's a finite supply. And the question is, do you have more buyers than sellers? Central banks swing a big bat when it comes to buying. And all you need is a 1 or 2% increase, a very small increase from the investor community to drive the price bonkers. And I think that's what we're at the very front edge of that.
For our listeners who are not familiar, the McAlvany family has been selling gold for many decades. David, I know you go to Switzerland often for business trips. Are the Swiss gold refiners, are they sending record amounts of shipments of physical gold tonnage to private sector Chinese dealers lately?
Yeah, so you're right. 51 years we've been in the business, and we've done a lot for helping folks put metals into IRAs. We're the first company to do that in '86, and helped get gold legalized back in 1975. We found a tax loophole that let us get into the business and be a bullion dealer to Wall Street firms from 72 up to 75. And our vaulted iteration is at vaulted.com, a savings alternative in ounces instead of greenback. And we like kilo bars. So to your question, that is the form that gold gets melted down and shipped to Asia. Your 24 karat kilo bar, when traffic picks up from the Swiss refiners, that's the form it's put into and shipped to Asia. And I think what we have is impressive numbers coming out of China in terms of their imports, and I don't know if it's the entire story. Where you see an official declaration of over 2,000 tons in gold from the People's Bank of China, I suspect that it's an underreported number. And I think that there is a geopolitical opportunity in the future and a very strategic announcement, which when they want to, they'll fly past our theoretical 8,600 tons here in the United States. So they've marked some progress. The imports have been impressive, but they've been a significant producer of gold for several decades now. And those are ounces that don't see the export market. Certainly they meet local jewelry demand, but I think you're looking at numbers that are far larger than the official 2,000 from the People's Bank of China. And I think that may be one of the challenges that the US dollar faces in terms of real direct competition. We do not have it today. We do not have real direct competition with the US dollar for hegemony, for world reserve currency status. We are number one. And the minor erosion that we've seen over the last 20 years is just that. Could it become major erosion? Well, it could. It could. And I think one of if I were writing the storyline to that, it would be the announcement of, say, 10,000 tons by the People's Bank of China at some point in the future, where other central banks, other reserve managers look and say, diversification has made sense from a trade standpoint. I think maybe we ought to consider the long-term stability of the RMB now that ... Now that they've established themselves as a legitimate, scalable, massive, source of credit and financial market stability. That's not who they are today. Their currency doesn't even. It's not even. It's.
Well, I mean, the Chinese Communist Party, are they trustworthy for most governments? So I know they're making investments for specific natural resource deals. I would say the terms are more debt diplomacy and not win-win scenarios. But the U.S. had a distinctive advantage for many, many decades, especially post-World War I, post-World War II, where we had a better rule of law than a lot of other countries and better capital markets. But I would say, David, since 2008, the people in power at the Federal Reserve Bank, U.S. Treasury, and the politicians and bureaucrats, the people pulling the levers here in D.C., they've been just playing fast and loose with all the rules, changing them all the time. If you're changing the rules all the time and you're picking out winners and losers, who to bail out, who to not to bail out, I mean, that's destroying the rule of law. The average person, even if you're a pretty affluent person, I mean, look at what happened with Russia. But if you're a company and the U.S. government doesn't like you, they could just basically confiscate your assets or tax or regulate you to death.
The history of the world as it relates to politics and power, and the main lesson I think we can take away is that you should trust no one. Whether it's the Chinese government or the US government, you should trust no one. This is the importance of the rule of law, because it's something that stands outside the idiosyncratic, power plays of the day. It's supposed to be something that safeguards a way of life to the degree that the rule of law is in play. I mean, I don't trust the U.S. government. I certainly don't trust the Chinese government. But again, this is the history of the world. Who should you have trusted through time? You read a little bit of Machiavelli and you see that actually there's an advantage played as often as it can be played. And we'd be naive to think that somehow one government is better than the other. They're all playing for an advantage, and it's not necessarily to the benefit of the people. It's for the benefit of those in power, period, full stop.
And I think, David, this was left out of the generalist history books during the post-October 1929 crash and after the credit boom of the 1920s and then the bust in October 1929, followed by the Great Depression. There was a lot of Americans that didn't trust Herbert Hoover and his administration, that didn't trust FDR and their administration. All that stuff's left out of the generalist textbooks. A lot of Americans, they were having their small businesses failed. There were all these wage and price controls, rules, regulations, taxes. The government forced a lot of businesses to fail. Americans were just fed up at that time, and they were buying gold as like a bankruptcy hedge and a deflation hedge, and then voting against the government. So I think we're going to see similar things play out now.
Yeah, and I mean, think about the resilient attitude and sort of the skeptical attitude that's expressed in this dynamic. You've got the Depression, 29 to 32, and it gets extended. You're sort of bumping along the bottom. You've got some big rallies in equities. Another significant decline in 37. Right smack dab in the middle of this, 1933, we come out with the Trading with the Enemy Act, and gold is made illegal. That's when we couldn't own it, and you weren't allowed to have it as a hedge against anything, right? You're supposed to hand it in fact. And there were a few exceptions to that. That's one of those exceptions that we got to play and justified our getting into the bullion business and have sort of a first mover advantage here in the United States back in 72. But I digress. 33 is the significant date. It's made illegal. You're supposed to hand it in on pain of 10 years in jail and a $10,000 fine. That's back when $10,000 meant something, right?
Yeah, it's probably over 100,000 in today's dollars. Yeah.
Well, except that 90% of the gold which was outstanding as currency, because remember, $20 gold pieces were the same as $20 bills. It now takes, a few more of those $20 bills to get you a $20 gold piece. But 90% of the outstanding gold stayed in the hands of the American people. They basically said, on pain of 10 years in jail or a $10,000 fine, we will take our chances. We look at the market dynamics. We look at the destabilization of the world. We just finished World War I. Are you kidding me? We're betting on the competency of government anywhere at any time, and we're being told what we can do with our cash balance, that we have to go to fiat. This is where I have great respect for the American people. You push hard enough, and you find real resilience. You find real grit. And I think it takes a lot of pushing to get there. And I don't think we're there yet. But 90% of the gold stays in the hands of the general public. Uncle Sam, the clear message from the general public is go pound sand. You can have it if you can find it.
Why do you think governments hate deflation, David?
Why do they hate deflation? I think it makes them very politically vulnerable. And I think that's the easiest explanation is you've got constituents who don't necessarily do what. Well, let's put it this way: they hate deflation more today than they used to hate deflation because we have universal suffrage. Prior to universal suffrage, I don't think they cared, or they cared very little. You had economists that cared, but politicians didn't have to care because, and frankly, we had a two-tier system. You had the haves, you had the have-nots, and it was mostly the haves that had the votes. But you universalized the vote, and now politicians have to care about the direction of the economy. They have to care about the budget because the budget is one of the ways that they can now leverage buying votes. And so if the budget is squeezed, if you can't spend what you used to, if there's a real economic and financial market crunch, particularly economic crunch, then you're at risk. Your job, your career as a politician is at risk. You know, it wasn't until sort of the 50s and 60s, post World War II, as we moved towards universal suffrage, that politicians cared. Economists did. Then economists, you pass their angst on to the politicians when the votes mattered.
I also think governments can't tax deflation. So if the consumer is not going out shopping or eating at restaurants or drinking at bars or spending on entertainment, and the asset prices of stocks, bonds, real estate, if those things aren't going up, I mean, the government tax receipts for decades now, the Federal Reserve Bank, starting with Alan Greenspan, called it the wealth effect. It was really the Cantillon effect. So they were inflating these asset prices. And all along the way, you had the state and local governments raising property taxes almost perpetually in a lot of different areas. And then also the capital gains taxes on stocks, bonds, real estate, the US federal government tax receipts on those were just getting super fat. In a deflationary environment, they can't tax these things and their tax base just blows up.
Well, and I mean, you're right. If you're talking asset price deflation, there's a huge cost, but there's on the other side of that a huge benefit to the consumer to see a deflation of consumer goods. And this gets into sort of the value of the free market, where if I can do a better job creating this product or that product, produce more of them at an even lower price, capture market share, the consumer says, yeah, I'd rather pay $5 than 10. I'd rather pay $10 than 20. If the price of the things that I need is coming down because productivity is increased or for whatever reason, it's like getting a pay raise that is not taxed. Deflation is the tax-free pay raise, and so it's complementing what you're saying. Just looking at it from a slightly different perspective, favoring the consumer as opposed to sort of the asset owner or the speculator.
Oh, yeah, I agree. I actually would love deflation. So if you have cash and you have a stable job with income, you're not going to get fired or lose your business or lose your job. Deflation is good. You get more purchasing power. It's not taxed. You can go buy more consumer goods for the same amount of purchasing power or go buy cheaper asset prices. But I think, David, what has happened now is you kind of have, I would say, age warfare, where like the boomers and the retirees, they were reliant on the high asset prices, but my generation and younger, so millennials, Generation X or Generation Z, the younger adults, they can't afford a lot of these asset prices, so they would benefit from deflation. But if you're a retiree or a boomer considering retirement, you can't afford for your asset prices to just collapse and stay low for years.
Yeah, no, that's exactly right. You know, there's an aspect of this that we're just trying to hold things together. Powell wants to hold things together. Politicians want to hold things together. And if it's going to cost $1 trillion or two more to hold things together, then let's do that. If it's Janet Yellen giving a blanket, protection of non-insured deposits along with the insured deposits, look, the cost is too great to allow for asset price deflation. That is the fear that is in the minds of economists and politicians because of what you just described. We have a generation that has benefited, multiple generations that have benefited from asset price inflation. And the world looks very different. We have to really consider trade-offs if we don't have the world as it has been. If the world is changing, then the whole landscape changes from a political perspective. And I don't think they want to lose that. I think they want to hold on sort of nostalgically to the best years, which really represented the tail end of a credit boom. But how do you do that? How do you hold on to the very best when it was unrealistic to begin with? When again, it was just kind of the last gasp of a credit boom as it's turning to a bust. This is where I think we get to see desperate politicians and economists destroy our currency to try to maintain that sense of nostalgia.
Yeah, I agree. The majority of both political parties here in DC, Republicans and Democrats, are kind of oblivious to actually the real math, the interest payments on the debt, the entitlements, the defense spending. I mean, both political parties are talking about either a high military budget or increasing the military budget. At these current interest rates, there's a lot of debt that needs to get rolled over. There's, David, about 3 or 4 different line item expenses for DC spending, and they're taking up the majority of the tax receipts. So if you add in interest payments on debt now, and that's going to grow larger, I've seen estimates that by the end of 2023, it could be over $1 trillion per year just in interest payments, military spending, and entitlements. That takes up a very large chunk of the annual tax receipts. So basically, the U.S. government is looking more like an emerging market kind of banana republic.
Yeah, I don't disagree. I don't disagree. And it's one of those things that I think in retrospect is going to be like the SVB big reveal. It was a problem hiding in plain sight. Yeah, and everything we're talking about, not rocket science. It's already there. The statistics are in front of us. We have frailties within the financial markets. The economy is not on a great footing. We can only grow if we continue to ratchet higher the amount of credit that's in the system. If there's any decline in credit growth, we're in a recession or worse. Like, our dependency on credit growth is so unhealthy. These are all the facts that are feeding into our conversation. And again, like SVB's balance sheet, Silicon Valley Bank's balance sheet, everybody sees it. It's just nobody cares about it because it's not an acute problem today. The day that you have flight capital from the dollar system, because people look at it and say, no, it wasn't sustainable, but it wasn't consequential last week. It may be consequential by the end of this week. I'll take my deposits out. That kind of disruption to the US dollar system, it's a Chinese participation event as they dump treasuries. It's a Japanese participation event as they dump treasuries. Why would they do this? I don't know. I don't know what the catalyst is any more than I know what tweet triggered the SVB collapse.
Well, Japan, David, to add to your points there, for Japan, I mean, Japan has been doing this longer than anyone else for many decades, over 30 years. And now they're having exchange rate problems and currency problems. So they need to dump their treasuries to get dollars to protect their own currency. So that's why you're seeing Japan sell a lot of treasuries lately, is to try to protect their own currency. But that's not working either. So they are running into a limit of financial repression and yield curve control.
I'll sound like a broken record here, Jason, but when you face significant change and people are not clear on what the implications of that change will be, and we're talking about a change in geopolitical relationships, we're talking about a change in the global financial market structures of capital flows, a change in trade relationships because of tensions between individual countries, and a change in terms of the ratcheting up of desperation of politicians and economists to try to make it like it once was. You're sort of buying normalcy again. All of these things argue for having a healthy reserve in precious metals. This is. I don't like gold as a growth asset. I don't even like gold, to be honest with you. There's so many other better assets to own. But during periods of disruption, during periods of uncertainty, you need to make sure you've got a lifeboat. And I look at the world, and the world is a lot like the Titanic. There's a lot to marvel at in terms of the engineering. It's fantastic. It's phenomenal. The things that we've been able to do in the global economy and within the financial system. Look at the kinds of financial engineering that we do. I talk to folks that deal with structured products, and they blow my mind in terms of the level of intelligence that goes into the derivatives market. But again, it reminds me of the Titanic. It's this brilliant engineering the folks that organized that trip across the Atlantic, one of the things that they didn't put much emphasis on was lifeboats. They didn't have enough. It was a low cost. Wouldn't have cost them an arm and a leg to make sure that there was adequate lifeboats on board the ship. But the presumption was of such amazing stability with the engineering that we didn't need them. What could possibly sink the Titanic? We lack the imagination, Jason, for what could possibly upend the global financial system in engineering, in its complexity, with all the brilliant PhDs and minds that have helped build it. And there is a lot there to marvel with and marvel at.
And yet every 2 to 5 years since 2008, we've had a large bank or a crisis. It seems like, whether it's a government debt crisis or derivatives crisis or a banking crisis. And these PhDs, instead of actually building new products or services, spending a lot of time, creating a new market for something or new industry, they've been creating derivatives and other structured products. So I think it's a waste of time and energy. I mean, it's good for the banks. The banks get enormous profits, and their profits are privatized and their losses are subsidized or bailed out.
Count the billions of people, count the trillions in the investment markets, whether you're talking about currencies, stocks, bonds, real estate. Just do just a quick tally. There's not enough lifeboats. What makes me bullish on gold is that there's not enough lifeboats. Gold is the lifeboat. And so by having some claim to a lifeboat in a period of financial market disruption, where the expectations of perfection in the engineering are all of a sudden questioned by real world encounters, this gets very interesting. And I'll say again, I don't like gold. I think there's better assets to own. Just like I don't like lifeboats, because it's not designed to be a pleasure cruise. There are no tea and crumpets served at noon. There is no champagne clinking. Everyone is desperate on a lifeboat. I'd much rather be on a yacht. And I think you keep that option open if you can get off of a foundering vessel and to what is next. Is that dry land? Is it the next iteration of something that is highly complex, really magical, really well engineered? I think we just need to take and remember that the world is changing, that the numbers just don't add up, that the hundreds of trillions invested in a variety of asset classes, the billions of people, and the limited number of ounces that do represent really the only feasible lifeboat in a world where every fiat currency is being downgraded and devalued. You've just raised the attention of the entire global community that they can't trust their currency either. You can't trust the yen. You can't trust the euro. You can't trust the dollar. You can't trust the pound sterling. These are all sources of demand to compete with the central bankers, who are saying the very exact same thing. The only reason they're interested in gold is because of insecurity, is because they look and say, we have reason to be concerned with our $7 trillion in reserves. And the uncertainty factor has us building something that we think we might need. What is that? A position in the lifeboat. They're staking their claim early.
Yeah, you've told me that you actually prefer dividend stocks and dividend growth. So, I mean, in this environment, though, there's not as many industries, especially with higher interest rates, because a lot of companies took on a lot of debt. So, and then consumers are not spending as much. So a lot of industries potentially there could be dividend cuts or dividends or cut back on.
Yeah, and I think it's just a question of sequencing. It's a question of looking at long time frames, like we were talking about interest rates and the bond market in the US and how these things move in long-term trends. I think the same thing can be said of gold and equities. You look at the interchange in the exchange between greed and fear as people position in one asset hoping for the best, encounter something less than the best, and then transition through greed to some excessive position in gold. When fear hits its maximum, you see the maximum number of people buying it, right? And this interplay and this exchange between extreme greed and extreme fear, we're nowhere near extreme fear in the marketplace. I mean, the VIX is sub 20. we're not that far off of all-time highs in your various indices. There's really no reason. Very few people are concerned in the equity markets. You have more and more people who are concerned in the bond markets. You have more and more people who are concerned who are managing central bank reserves. But frankly, the bond investor and the central bank asset manager, these are the smartest guys in the room. The equity investor has long been considered the stupidest guy on the planet.
Well,
And so
also,
the fact that they get it last, that's not going to come as a surprise.
I think the Exchange Stabilization Fund and the Plunge Protection Team are propping up the general stock market indexes with like Facebook, Amazon, Apple, Netflix, Google, some of the major large cap big tech stocks. Those are the ones that are outperforming. David, if you look at the small caps though, so the Russell 2000 or the Russell 3000, which is a broader market gauge of the small caps. I mean, the small caps are making lower lows. I mean, the small caps are really getting crushed by those higher interest rates and lack of consumer spending. They can't go and easily raise capital. Even if they're a pretty good business, if they took on too much debt at a higher interest rate or the consumer stops spending, I mean, they're getting really killed right now relative to the larger big cap tech stocks.
Or just stay with the S&P 500. If you want to have an apples to apples comparison, S&P is cap weighted. It's up 9% this year. The equal weighting of the S&P, if you wanted to measure them out, 0.2% allocated to each of the 500, as opposed to the disproportionate allocation to the top five, and Apple being the top one there with over a 7% allocation, you're only up 2.9%. So 9% for the cap weighted, 9.2, and the inverse, 2.9 for the equal weighted. It's telling you that breadth is already in a not so great place. You don't have money which is winning across the board in equities. You've got money winning if it has exposure to Apple, Microsoft, Google, Amazon, Meta, NVIDIA. That's it. There's your winners.
So the majority of stocks have underperformed the consumer price index then.
Yep, that's right.
And if the consumer price index, and I think this is why people are looking at gold, because they're saying that the treasury yields are below the consumer, they were below the consumer price index. I think now the Fed has inverted the yield curve. But, a lot of people are saying we don't trust the U.S. federal government. Look at DC spending. DC is still talking about even more spending increases here. I mean, at some point, the U.S. government finances are going to get they're going to get even crazier than what we have now.
Well, I mean, again, this is the federal government being just like SVB. The problems are hiding in plain sight. Nobody seems to bat an eye at our year-to-date $1 trillion budget deficit, on track for the full year $2 trillion budget deficit. We're not in a recession. We're not in a depression. We're not in the middle of a global pandemic. Why are we overspending by $2 trillion? I mean, again, some of these things, we've just gotten used to stupidity coming from Washington, and we don't think we need a stupidity hedge anymore because nothing's really been disrupted. It's not that bad yet, right? But the problems are hiding in plain sight. SVB all over, just on a large scale. And now you've got the problems tied to the heart of money and credit, which is the US bond market. Credibility tied to the Federal Reserve, credibility tied to the Treasury, credibility tied to an inability to do something as basic as manage a checkbook. They're overspending by a little? No, a lot, a whole lot.
As we wrap up here, I want to get your thoughts looking back on one of the best interviews you did on the McAlvany Weekly Commentary. I think it was back in 2015. You interviewed Carmen Reinhart of Reinhart and Rogoff. She wrote these books. You got her to admit a lot of things about financial repression and inflating the debt away and yield curve control. Do you think that that's still the plan for the U.S. federal government, or do you think there's a new plan now involving some type of debt devaluation or debt jubilee or a new trick to usher in central bank digital currencies?
Yeah, I think the new game is the old game just brought forward into the 21st century. So with a technological refresh, central bank digital currencies will be the wave of the future and the best way to enforce financial repression. Because as she said in the interview, it's really important to be able to corral investors and then choose the winners and choose the losers. But you've got to be, I mean, again, think of the herd. Think of yourself as being a part of the herd. You got to be able to get everybody in one bundle, and then you choose who wins and who loses. That's the nature of top-down financial repression and control. And the best way to do that is to gain access to every transaction possible, where nothing escapes the purview, right?
So no
Now
all
you're talking
cash,
about
no all cash, and there's a digital footprint then for everything.
digital footprint for everything. And where I probably go a little too dystopian is to think that there's preferred vendors for this or for that. You know, tie it to the way the Chinese are engineering their credit scores and their sesame credits. If you're a good citizen, your money buys the current market value. If you're a bad citizen, however bad is defined, well, then your money buys things, but it's at a much higher price, or the value of your savings are discounted. You know, so your purchasing power is less. Do you want to be a good citizen or a bad citizen? There's things that can be done through a central bank digital currency that would have. I think John Maynard Keynes would have just absolutely felt like he died and gone to heaven. You know, the ability to destroy the rentier class, the ability to get every dollar within the financial system churning and effective. He didn't want any dollars except his own, of course. There's a little hypocrisy there, but he didn't want any dollar outside of the economy. He wanted every dollar off the bench, in the game, churning as fast as you can to create a beautiful world. So we're moving towards someone's version of utopia, and it's informed by a sort of neo-Keynesian notion that we can and should determine how decisions are made within the financial markets, and we will encourage with both carrot and stick that precise outcome. That's your central bank digital currency, and it's coming.
Do you think the central bank digital currencies make it easier to force people's retirement account and savings then into U.S. Treasuries, so then the government can say, hey, China, Japan, Germany are not buying our treasuries. It's a national emergency. We need people to go and buy treasuries. And then it's very similar to past financial history, where you're forcing citizens to buy basically war debt or government bonds during a war, a crisis or a war, and then the government's just going to inflate the debt away. Do you think that's like a similar principle using the new technology?
And it's possible. You know, all you have to do is redefine the word prudent, and then all of a sudden the prudent man has to invest X percent in what we have already determined to be the right choice. So the Prudent Man Rule says 10% of all allocations should be to treasuries. All right, there you go. You're out of step with the law as a fiduciary if you're not following the Prudent Man Rule. You know, how does Wall Street avoid it? It's you go to redefining words, and the words set the tone socially, because now the law is the force behind, you know, the trend. And I think what you're describing is very possible. It's feasible. Central bank digital currencies, do they accelerate that? I think it just gives them the ability to make it happen on a uniform basis.
Well, Wall Street actually uses U.S. Treasuries as "quote unquote" pristine collateral. It's kind of a ridiculous term, but they use it for as collateral for all these derivative trades, and then it's the U.S. Treasuries are hypothecated and rehypothecated. So that would just be, if you're forcing the Wall Street banks, large ones or hedge funds, to buy more Treasuries, they're just going to probably play more games in the derivatives market as leverage trades with the collateral.
I don't disagree.
This is the wacky system we have, where all the people at the top of the system get to play fast and loose with all the bailouts and rules, and their profits are privatized, and then that's why since 2008 the banks and the hedge funds have gotten away with so much.
Jason, I mean, a really basic question. I think some of this boils back to sort of foundations of why we do what we do. I think everybody listening to this needs to ask the question, what do you want? What do you want? The reason why that's important is because we will allocate capital in ways that give us a sense of freedom. Do we have the freedom to do what we want? Some people will say, well, I want to own passive income, you know, producing real estate, because what I want is a life of financial freedom where I don't have to worry about going to work. I know that there's mailbox money coming in. What do you want? You're going to make a whole host of decisions when it comes to allocations that relate to that. I answer that question in a way that comes back to just even being able to maintain the opportunity to ask the question, can I maintain my agency? Can I maintain my agency? Can I choose what I want, regardless of who's in office, regardless of what political party it is, regardless of whether or not we have a central bank digital currency or not, can I still pursue what I consider to be my greatest good? Or is that being precluded? You go back to Alan Greenspan's essay on gold and economic freedom, and he makes the case that you can't maintain agency. You don't have free will, except in a philosophical sense. In a practical sense, your free will is limited when you move away from gold. Gold is something that maintains agency and allows you to continue to ask that question. What do you want? Okay, go do it. What if you don't have resources that are outside of the financial system? What if you don't? Well, then you will do what you are told to do. You will do what you are told to do, not what you want to do.
Yeah,
Agency and this notion of freedom has to be safeguarded. And I don't know that the rule of law is necessarily going to be that which protects us anymore. Go back and read The Law by Frederick Bastiat. And he makes the case that the law is either that which protects you or abuses you.
Well, I
Same
know
law.
that, the people here in DC have a lot of law degrees, and they like changing the rules for their benefit, or the large corporations and special interest groups. But I think you make a great point there, how the average person now, with all the rules, regulations, taxes, red tape, they just don't have as many choices and freedom. So maybe they could start an online business, but the opportunity to go and start a bricks and mortar business is a lot more costly. There's a lot more rules, regulations, red tape, licenses, and then on top of that, the taxes. I just see these governments, whether it's the U.S. government or the other governments, they all want to debase their currencies and lie about it, and then increase taxes and reduce our freedoms.
What do you want? What do you want?
Well, you want to vote out of the system. Then you don't want to be holding long-term fiat currencies, and then government. If the government is doing bad behavior, you don't want to buy government debt because it's condoning bad behavior.
I do think that ounces are an expression of an opt-out.
I agree, and the younger generation seems convinced that Bitcoin is better than gold and silver, so they're not diversified. So the younger adults are going all in on Bitcoin, from what it sounds like.
They may be right. I just suggest that they hedge that bet as well. You know, I don't know how this story unfolds. None of us do. And if they're right, God bless them.
Well,
if they're not, if there's a wrinkle, if there's that system dependency, because you still have to be tapped in, you still have to reconnect, then maybe something as basic as private, portable, and I appreciate these are the cases that are made for something like Bitcoin. But you've got something that is already money good everywhere in the world, and it remains to be seen if Bitcoin will be money good anywhere in the world. Perhaps it will be. I'm not a Bitcoin skeptic. It's just not where I've chosen to put my treasure.
Yeah, I'm not anti-Bitcoin. I'm actually in favor of diversification. I just hear people saying that gold, Bitcoin is gold or silver 2.0, and I don't want to own any metal anymore. And they're not. And I ask them questions, like basic questions: are you diversified? Oh, I'm all in on Bitcoin. Or, oh, I don't have enough savings to be diversified, and so they just buy more Bitcoin. I don't think it's a good strategy in this environment where politicians, bureaucrats, regulators, central bankers can change the rules pretty much as they please, to be all in on any one single asset class.
That makes sense to me.
Well, David, I really enjoyed our discussion today. If you want to tell my listeners more about the Vaulted app, because it's a good opportunity for retail investors to buy bullion close to spot prices, how do they do so?
Yeah, if you want to go to vaulted.com, or you can download the app. In June, we will have silver launched as a part of that program. Not until then, if you want to get on the short list to be first in the first 2 weeks of June, instead of waiting till the end of June on the official launch, feel free to register for that. Nothing beats the cheapest silver bars on the planet, and that's what we'll have. So look at the 1,000-ounce bars. You can position in 1 ounce, 2 ounces, 10-ounce increments, 50 million ounce increments. You just let us know. We'll be happy to accommodate. Vaulted.com is a great way to look at savings in ounce form, and McAlvany.com for everything else. We do the commentary, hard asset insights, a weekly blog as well as Credit Bubble Bulletin with our own Doug Noland. Great set of resources at McAlvany.com.
And just like me, you were podcasting for over a decade before everyone else was doing it.
16-year anniversary every week. A long time.
And a lot of great guests along the way. Some of the best information out there for free is hidden in your podcast.
Well, thanks, Jason. We appreciate that. Those are kind words.